So if you're new to Finimize and you're wondering what Finimize is about, Finimize makes it easy for you to keep up with the financial news in 5 minutes or less every day with your daily emails or Finimize app. Part of the Finimize manifesto is that we want to keep ourselves and everyone around us informed with financial information so that we can become our own financial advisors. Which is why at this time, we feel that it is important for us to know what's happening in the market, and we set out to talk to financial and investment experts to understand what can we do. I'm very, very excited here today to have Finimize Australia coming together, and not just Australia, we have everyone from all over the world, it seems, to have a discussion with our panelists from Sydney and Perth. We have Doug Morris, the CEO of the investment portfolio tracker Sharesight, as well as Dave, the author of personal finance website Strong Money Australia. I will get started with you, Doug. I understand that you come from Texas, United States, and you have a bachelor's degree in psychology. Can you just briefly introduce yourself and share with us why Sydney and how did you get into the world of finance and investment?
Sure. Yeah, sure. Thanks everybody for joining, and thank you very much, Etfs, for having me on the panel. So I actually went to uni in Texas, but I'm from Chicago originally. But I've been living in Australia in Sydney for just over 10 years. I worked for a company called Morningstar. They are an investment research company, and they provide data and commentary on markets and things like that. So I took an opportunity to move to Sydney, which what I thought was going to be a kind of a short little stint, but a wife and 2 kids later and a dog, and I'm still here. So that's kind of what brought me down here. And I got started in investing from my dad. Really, my dad was a futures trader on the trading floor at the Chicago Board of Trade. He traded soybean futures. If you've ever seen the movie Trading Places, or even the scene in Ferris Bueller's Day Off, that's kind of what those guys are doing down there, yelling at each other and waving their hands around. So I worked down there, and I got to kind of learn the markets from him, which was kind of my entree into the investment world.
Awesome. All right. I'll move on to you next to you, Dave. I understand that you moved to Perth from country Victoria when you were 18 and reached financial independence when you were 28. Share with us what happens between that time and now.
Okay, yeah. So thanks for having me on the panel here. It's good to be here. So it's a bit of a long journey, and it turns out from me moving to Perth when I was 18, and then finding a job in a sheet metal factory just as a labourer and a factory hand. And I did that for about a year or so, and I started looking around at work and realising that people that were 30 years older than me, 40 years older than me, had been doing that same job week after week for so long. And I kind of envisioned my future that's going to be me in 30 or 40 years. And they didn't look very happy, and they didn't look very satisfied. And I thought, no, there has to be another way to live. I didn't want to work 40, 50 hours a week for 40, 50 years and have not much free time and not much choice over how you live your life, basically. So that kind of, I guess that kind of spurred me into action and kind of pushed me down this rabbit hole where I started learning about, well, I'm going to have to build some wealth or do something so that I won't be in that position when I'm older, and hopefully I can retire like a lot earlier than they were planning to. So that's when I started learning about saving and investing, and I got very heavily into that and started saving a large percentage of my paycheck and putting it into property at first, and then later I started investing in shares as well. And because of the saving over the years, I was, like you said, I was able to actually stop working at age 28. Yeah.
Right. Yeah, I would like to deep deeper into what you said about investing later on. Doug, just to get started, if you have to explain what Sharesight is about to those of us here who is a beginner investors or who haven't invested before, but are curious about it, what would you say?
Sure. So Sharesight gives you clarity on your investment performance. We make it really easy to understand exactly how your portfolio is going in terms of performance. We'll show you the impact of share price movements, of dividends, and of foreign currency. We've got some advanced tracking and reporting tools, and we can help you out with tax as well.
And Dave, so share with us, how long have you been investing, and do you consider portfolio tracking an integral part of your investment strategy?
I've been investing well, in the early days, I started off with a high interest savings account where you were getting maybe, in those days, it was probably like 5% or 6% interest, which I thought was pretty awesome. And then a couple of years after that, I started investing in property, which was probably about 10 years ago or so now. And as for shares, I've been investing in shares for about 5 years now. And I actually use Sharesight myself, and I find it really helpful especially for tax time, because it just like everything's covered in there. You sell some shares, that's taken care of, and it tracks all your dividends and that. So I'm a fan of Sharesight.
Okay. So what was is there a specific reason why? Because I understand initially you invested in property, and then later on in your financial independence journey, you moved on to shares. So what was the reason behind that?
I think I got to the point where we'd built up a decent amount of savings or net worth, and me and my partner, we were realizing that having that equity or having those savings tied up in property wasn't actually going to provide us with any sort of real income stream. And even if we sold some of the properties and paid some others off, the income from property in most cities in Australia, after all their expenses are paid for, is very, very low especially compared to what you can get from like Australian shares, for example, where there's no costs and the dividends are quite generous, and plus you get some tax credits in the way of franking credits on top of that. So it was just a realization of, if we have our savings over here instead of here, we're going to have a much better outcome in terms of income to live off to actually retire.
Yeah.
So that became more obvious at the end. Yeah, I didn't really realize or know that at the start.
Yeah. I think for myself as well. I think as we have extra savings, we were thinking, should we buy property or should we invest? I think one of the benefit of investing, I find, is that being able to be flexible, having a property sort of tied you down to a place. Doug, I think you are also an investor yourself. How long have you been investing, and what's your driver or take in terms of why you're investing for yourself?
Yeah, so I've I think I bought my first share in Disney about 22 years ago when I was in high school. I'm 38, so I'll save you from doing the math. And it was part of a stock picking competition in high school that I was involved with. So I guess from there, my kind of philosophy, my strategy is I invest mostly for retirement. So I take a very long term view. I do what I can with a self-managed superannuation fund, and then anything outside of that, I still kind of employ the same sort of philosophy, which is kind of buy and hold. I guess you could classify me as a pretty concentrated investor. So I own it's about 17 or 18 different positions at any one time, but usually no more than 20. And I tend to prefer companies that I keep investing in, so like dollar cost averaging or even just systematic sort of savings, really, is the way that I think of it. And I like to pick companies that I'm really familiar with. So I always think about, is that a company I could work for? Do I understand their business model? And then I like to kind of do a deep dive in the company. So if you have a look at my portfolio, it looks quite technology heavy, given that Sharesight's a technology company, but that's what I know, and that's kind of how I invest. I don't pay much attention to dividend yields. again, given kind of my age and I'm going for capital appreciation, a bit more risk, especially with tech companies. I don't tend to like dividends. Although that being said, my Australian brain is kind of loves dividends with franking credits and all that, but my American brain, where the dividend yields are so much lower, we don't really pay too much attention to dividends in the States in comparison. But yeah, I kind of stick to my patch and I go with what I know. And I always kind of like to start with like a macro view, like, all right, what's going on in the world? What's going on with this country or this sector? And then kind of try to cherry pick an idea below that.
Yeah, I agree. When I started investing, I started with mutual funds, not shares. But I was working in Malaysia before in agriculture. So I started looking into plantation companies and energy companies, basically companies that I can understand. All right, Dave, what are your fundamental principles in investing, and has that changed over the years, especially at this time with what's happening around us?
So for us, we really found that in terms of the thing that helped us most with our investments was actually the savings that were going into those investments, because of the time frame that we had, which was like 8 to 10 years. You don't have that long for compounding to take effect. So we found that in that short space of time that most of our results actually came from savings, which was kind of surprising to find out later on. But in terms of the principles I try and stick to, I try and maintain like a very long-term focus. So I'm a buy and hold investor. I like to buy diversified funds, so I don't really like stock picking. I've done it for a few years in the past, but I didn't really enjoy it as much as I expected, because I found myself, I guess, thinking about those companies all the time and trying to imagine their futures and stuff like that. And it became a lot more work and a lot more consuming than I thought it would be. So I decided that I enjoy more investing in diversified funds, whether it's just index funds or listed investment companies where I don't really have to do any work at all. And I can just buy funds that are low cost and they're ready made. And so it's all very passive, you know?
And I also remember that you've spoken about focusing on dividends growth in your investment strategy. Can you share with us about this and how has it worked for you?
Yeah. So when I first come across the share market, I think, as most people, it seems like a bit of a crazy casino at times, especially if you don't know much about it. So the thing that got me to, I guess, understand the share market and feel comfortable with it was looking at the dividends that companies pay rather than the share prices fluctuating all over the place. It just tended to make more sense to me because I could relate it to, okay, rather than focusing on market prices, I can focus on, okay, these companies or this basket of companies makes X amount of dollars per year in cash and they pay some of it to shareholders. So essentially I think of it like companies are saying, like, every 3 months or 6 months, hey, here's some of our profits, and they just plop it into your bank account essentially. So I like that in the sense that it provides a form of regular positive reinforcement where you're kind of remembering why you're investing, and it gives you that positive trigger about what you're doing. And it's a handy source of income, especially if you're living off your assets. So I find it pretty convenient, and dividends are going to get paid whether you like it or not. So you might as well take advantage and use those payments rather than spend them to obviously buy more shares and compound your money over time.
Yeah, so sort of looking backwards, planning your investment by looking at which companies are paying dividends and seeing how much you can get out of it every year. All right. Doug, I am a beginner investor, and just looking at your my investment portfolio can be overwhelming. We don't know what information we should be looking at to evaluate how they're performing. So can you share with us, based on what you do at Sharesight, what do you think are the top 2 metrics that we should be looking at to know that we are doing okay or good in our investment?
Yeah. That's a good question. I think I guess what you're asking about is kind of like benchmarking in a way, and how am I going versus my peers or the market as a whole. Um, I think the lens you got to think about first is like, what are your goals, right? So like, what's your time horizon? As Dave said, are you focused on yield, because you need that cash for sort of living your life, or are you focused on kind of long term capital appreciation? So I guess picking the right benchmark is really important. Um, I think understanding what the overall share market is doing in your country of it can be misleading though. If you see sort of the ASX 200 performance, you'll see this bandied about in the news all the time. That's a basic price index of the stock market of the biggest 200 companies that trade, which may or may not be reflective of your experience as an investor, and that's also a synthetic thing. The only way to invest in that 200, the list of 200 companies, is to buy an ETF or a fund that tracks exactly that. And then that's all about when you get in and what the fees are and things like that. So it's important to note that you're not going to, track that performance exactly. So I like to think about how to track myself. I look at sort of the country's performance of where the investment lives. I look at the sector or the industry that it belongs to, and the performance of those specific sort of micro indexes, which you can find on places like Sharesight or on Bloomberg or anywhere. Bloomberg.com, not the fancy terminal, just the free news website. And then I also like to think about sort of how I'm going in terms of like comparing yourself to your emergency strategy, right? So the way that I set up my benchmarks in Sharesight, I guess, for example, is I pick something that's my true plan B. So I'm running a business. I've got a 5-year-old. I've got a 2-year-old. I'm pretty time poor. And so if I don't have time to run like a really focused, active sort of strategy, like really pay attention to those companies, I do like to kind of allocate some funds to a plan B scenario, or even do like a core satellite where I kind of have like a bedrock that I invest in, and then I have some more risky, smaller plays that I make around that. So like a core and satellite kind of metaphor. And as Dave said, that plan B might just be a diversified ETF or a managed fund or something like that, a mutual fund, depending on where you live, which, if you have no time and you're not going to make good investment decisions, you're better off paying somebody to do those for you, to do those on your behalf. And you can find that kind of stuff easily through an ETF or a fund. So that's kind of what I think about in terms of benchmarking. So like start kind of macro level, high level, like, okay, how am I going against the country, this industry? Maybe compare yourself against, say, the S&P 500 or the Dow Jones in the States, because the States represents about half the world's invested capital, thereabouts, is in the U.S. Because the economy is so big, and because they have so many international companies, like Nike and Coca-Cola and all that, who make their revenue from overseas. They just happen to be based in the U.S. So that's always a good proxy as well. But then think about like, okay, personally, my plan A versus my plan B. And if your plan B is consistently doing better than your own sort of portfolio management decisions, it may be time to kind of rethink your overall approach.
Yeah. I think I can relate when you're talking about plan B. I was looking at investing in some managed funds, and while reading that information, I found out that they're tracking their investments to a certain ETF or something, and we found out that they have a lower fees. So we were thinking to ourselves, why do we want to pay them higher fees when they're investing in the same thing with a probably even lower performance than what they're tracking against?
Yeah, these days, just to add on to that, these days an ETF will almost always be cheaper than a mutual or managed fund, especially in Australia. There can be some benefits depending on how you're accessing a fund, like through a super, which is using a platform. That's usually when an advisor's involved. But so there can be some benefits there. But there's something for every level of investor vis-a-vis an ETF these days. so yeah, you can find sort of a style or a strategy for you for really, really low cost.
Yeah. Okay. What about yourself, Dave? What's if you can share with us in terms of what's your overall or macro strategy in terms of your portfolio, and how are you tracking them?
Yeah, so like I said before, our investments really focusing on holding long-term funds, buying consistently over time, and keeping costs low and stuff like that. And it's my goals mostly focused on cash flow right now because of like we want the income to live on. So at the moment, we're trying to build that up while we sell off our properties over time. So we'll sell a property and get a chunk of cash, and we'll drip feed that into the market, and hopefully our dividends will be growing consistently over time because we're putting more money in. So that's kind of my benchmark, is just growing the portfolio and doing this transition thing that we're currently doing, and getting that income to grow each year.
All right. And does that mean looking at the bulk of Australian stocks and shares?
Yeah, mostly my portfolio is Australian shares right now, and we have our super invested in international shares.
Doug, I think there's a lot of noise right now about where to invest and what should we do with our money. Some people are thinking that I'm pulling all of my money out into cash, and I want to sit on them until all of this is over. Whereas some people will say that you are crazy, you should be buying in the dip. I've seen a company called Core Data, Australian company that sort of assess the sentiments of Australians. And I think they found out that 68% of Australians are currently not planning to buy anything, and they're just keeping their money in cash. What are your thoughts on this? Especially looking at the patterns from Sharesight, how are the investors behaving at the moment? If you can share with us.
Yeah, so I'll answer kind of two. I'll answer kind of, I guess, what I think personally and what we're seeing with the data on our platform. So personally, for me, I've been really keen to get some cash into the market. I don't honestly know if we've hit the bottom yet, but I don't really care. This is a discount. It may not be the best discount that we're going to find. It may not be like a Black Friday sale, but it's pretty good. So if I'm going to invest for the long term, which I am, and I can get really high quality companies at a slight discount, I'm going to take that. So that's my own personal feeling on that. And I can share a couple of slides, Ati, if that's fine, if that's okay with you.
Yep, I'll just stop my screen share, and you can open your screen.
Let me just, let's just grab, I've got a couple of things I had in my back pocket here. So disclaimer, I'm not a financial advisor, so I have to say that. The lawyers make me say that. So anything you hear from me is my own personal opinion. And please seek out advice if you do want to invest based on what I've heard and what you've heard from me. I guess just to go to this chart here, this shows for all the trades that we've tracked for April. So this is about 3 weeks worth of data on Sharesight, and this maps to, we've got about 130,000 users, and in Australia alone we've got about 70,000. So it's a big data set, and the orange colors represent buys, the black color represents sells, and these are basically stack ranked from the most highly traded investment in the top 22 to number 20. So these are heavily traded stocks based on our user base. And what's interesting here is there is more buys than sells if you just visually look at the colors in front of you. It's good to see people are kind of loading up on Vanguard Aussie Shares, which is an ETF that tracks the overall share market. People are loading up on some high quality companies as well. So CBA, Macquarie. Interesting that Webjet's in there, given all that we've seen around, Flight Center and Virgin and all that recently. Like, this shows me that at least our user base they're kind of maybe gearing themselves up for a real pop in travel and kind of getting back to normal. That's going to come roaring out of the gates. But that's why I used the word kinda in here. You can see the number one most traded stock, which is split between buyers and sellers, is a bear ETF. And what that means is that it's an ETF that's designed to short the market. So we have a lot of people who probably went into the bear ETF when when things were really falling and are now coming out of it, which is the sells. But there's an equal number of people who are piling back into the bear ETF, maybe as they come to the realization the economy might be in real trouble. That's just my own kind of spin on what I look at here. So that's what we're seeing. So I guess on the whole, it's people are buying these companies at a discount. If you consider that 19 of these, well, I guess Afterpay is kind of split as well, which is maybe more of a commentary on the economy and young people. But 18 out of 20 of these are sort of buying opportunities for quality companies.
Yeah. Okay.
Can I just jump in? Do you know if do you know what the volume was with people buying the bear ETF, say like at the end of last year or in January versus when the market actually started falling?
Oh, it would have been like 0 to infinity. Like, no, you know what I mean? Like, because we've been on this bull market run for so long, and everyone, I think, got desensitized to it. And, so it would have been one of those things where people were doing a real short-term thing, I reckon. But we should probably pull the data on that. That'd be a really good story to tell, I think.
It's funny that people buy the bear ETF after the market's gone down versus before.
Well, and the thing about some of these are called like exotic ETFs, is that they're really expensive and they reset every day. Well, I don't know about this one, but most of them do. So if you're out there thinking, hey, there's a lot of volatility in the market, I'm going to play this, aggressively. I would say buyer beware. The market's just whipsawing around. I mean, I checked the headlines just before we jumped on tonight, and the Aussie market was all over the place today and finished like flat. But these ETFs in particular, they're designed for day traders. And so they have it's all synthetic, and I won't get into that stuff right now, but they're designed to reset every day. So it's kind of like a heart rate monitor that kind of does this. And if you're not paying like real-time attention to these, they can get you into trouble, and they're expensive too. So just read the packaging with these ETFs, please.
So I think just going back to what you've said, for everyone here who might not know what exactly is a bear ETF, can you just briefly explain, Doug?
Sure.
Yeah.
So a bear ETF is basically, if you're familiar with what shorting the market means, you can buy a derivative futures contract, and I won't get into that too much. But basically, you're making a bet that the share market on the whole, which is comprised, of course, of hundreds of companies, will go down. And so they build this ETF, this portfolio. It's a portfolio of all these futures contracts on shorts. Will basically do the work for you. And if you say, okay, I bet the market's going to go down, you buy shares, you buy units in this ETF, and it'll behave accordingly. So it's basically your way of mimicking what a highly paid portfolio manager would be doing if their mandate was to be shorting the market. So it's these things are complex, and because they're complex, they tend to be more expensive than your average ETF.
Right.
Whereas the term bear is bear market. You wouldn't really see the inverse, which is the bull market. The assumption there is that a buy and hold is the assumption that it'll go up like a bull market.
Yeah. So correct me if I'm wrong. Is sort of betting on making money when the market is going down, or can be both scenarios?
Sorry, could you say that again, Afti? I didn't catch that last part.
Yeah, sure. So just correct me if I'm wrong, if I'm concluding this right. So is bear ETF is about betting when the market is going down, or is it like both ways? Yeah.
Yeah. So in general, a bear ETF for anything that has the word bear on it is a bet that the market will go down. And the other thing to think about there is when. And so you'll see that in these names of these ETFs, they'll have like bear market 1 month or 3 months. They can build it so that it's sort of they have a duration in mind as to when the market will go down as well. But that's why you really need to read the PDFs and stuff very carefully.
Yeah. All right. And sounds very, very complex from the sound of it. My next question is to you, Dave. what are the common misconceptions do you think that we have around investing? And for a beginner investor, what should we be wary about with these misconceptions? And what can we do about it?
Yeah, well, there's a lot of them. So I'll just share a couple. I think one of them is a temptation to wait until there's no bad news, or to start thinking that you're going to be able to make clever trades like buying a bear ETF and thinking you know which way the market's going to go next, because pretty much nobody does. And just on the bad news thing, I think people want to wait until, say, the coast is clear and the dust has settled before they start investing, or before they really ramp up their investing. But there's always something to worry about, and there's always going to be scary headlines in the media. So if you want to invest, you just have to get started, because those scary things are never going to go away. And even if it does seem like it's not the right time to invest, usually scary times like this are typically good times to invest, because prices are lower than they otherwise would be. You can buy more shares with the same amount of dollars, and so it's a great way to build your portfolio if prices are lower, before prices eventually do recover.
Yeah.
Another one I'd say is that people assume that shares are risky, and in the short term they are, because they are a volatile asset. But if you think about shares over the course of your lifetime, or our lifetimes, they're an extremely dependable asset class for growth and income over the long term. So, and if you think about it in simple terms, if we just break it down very simply, if you're buying an index fund, you're really just making a long-term bet on the future of Australia, or of the global economy if you buy a global index fund. So it can be very simple. You don't need lots of knowledge to invest. Investing doesn't have to be complicated. It can really be as simple as you like.
Yeah. And
yeah, I've got.
Go ahead.
Sorry.
No, go ahead, Doug.
Well, I was going to say, Dave's absolutely right about that. Over time, it does pan out. I love a good chart, and I've got one here that I think really tells Dave's story really well. So this chart is from Morningstar, and there are researchers there where I used to work. This shows since 1870 the return on $1 invested over 50 years. So as Dave said, over the long term, yeah, there are going to be some bumps along the way and some volatility, but you can see that it's the general trend is up and to the right. And even in the current crisis, which is reflected by that. So the market was, just before COVID-19 took hold on the stock market, the market, your return would have been $19,000 or thereabouts. Your value is now sitting at $15,000, which in the grand scheme of things doesn't even register as almost a downward movement in this. So, and you can compare that to the GFC there towards 2010. You can compare that to Black Monday in 1987, which barely even registers here, and so on and so forth. So it's really important to zoom out and keep what Dave said in mind, and take that kind of that longer term view, in my opinion.
Yeah.
Just having some perspective of what's panned out in the past, all those scary events that are scarier than what we're experiencing now, and the world moves on, the world recovers, economies grow again, companies prosper, and the whole cycle continues, So it's just about keeping the long term in mind, and having some awareness of history and how things do actually recover, even though it might not feel like it's going to at the time.
Yeah. And I think touching on what you've said about taking advantage of this time to learn about investing and what's happening in the market, I tried out the ASX share market game, where they give you 50,000 sort of virtual money to play with. And I think that's a good start, just to see what you can buy and how those stocks are moving with what's happening right now. I think the game is open until June this year. So if any of you are curious about it, just jump on the ASX website and sign up for it, and see what you can do with 50,000 virtual money. Okay. So I have my last few questions for both of you. Actually, last questions for both of you. If there is one thing that everyone here can take away from this market, and one thing that they can action on immediately after this event, what would be it from your perspective? I'll start with you, Doug.
Oh, gosh, one thing. Well, I would say, I guess I'll speak to kind of the newer or just getting started investors who are on the call. A couple of things. Don't worry about picking the bottom. Like Dave said that, I think don't stress about picking the lowest price. It's not about discount shopping. It's about buying a company you're really familiar with. That think about, like, maybe you use their product or maybe you want to work with that company. Go download their annual report and read that thing. It's not as boring as reading a balance sheet, although that's in there too. But it's a really good story that the CEO and management will tell you about their company, and the good ones will get really excited about it. If you want a template, go look at Berkshire Hathaway and read what Warren Buffett has to say. It's a great read. And I would say too, if you're about ready to make your first investment, start small. Go with maybe even the minimum that the broker requires, and just prepare yourself to lose a significant portion of that money, if not all of it, over the short term. Just keep that frame of mind. And that sounds scary, but it probably won't happen. And I think that's a good way to kind of put a toe in and go from there.
Yes, I think one of the things that we discussed at the previous Finimize events is to start investing with the money that you can afford to lose. That mindset. Yeah. What about you, Dave?
Yeah. So I'd say, first of all, especially if you're a beginning investor, it's tempting to. I mean, it's almost inevitable that you're going to get this analysis paralysis because you're looking at so many different options, so many different strategies, so many different companies, and it's almost impossible to know where to begin. So the first thing I would say is to just stop for a minute, take a step back, and remember that it is possible to keep it simple. You don't have to try every strategy or invest in every company, or just get started with something that you're comfortable with, whether it's an individual stock or whether it's an index fund or whatever. Just get started and just learn as you go. Don't think you have to know everything up front at the beginning, because nobody knows everything. Everyone's still learning. So it's just about getting started and moving forward. And if you think the future is going to be bright, then there's not much to worry about in terms of like short-term headlines and, you know what I mean, the ups and downs. If you still think that the long-term future for Australia and for the world, and so by proxy for the stock markets, is going to be just fine, then that's what you need to focus on, and try and ignore the scary headlines.
Yeah, I agree. And in terms of taking the approach of learning instead of feeling like you should know everything from the get-go, you will only keep learning as you try more and more, I think.
Exactly. Right. Yeah. So just get started before you feel like you know enough.
Yeah. Okay. Cool. I want to open the discussion to question and answers with the audience. Remember that if you have any questions, type your questions in the Q&A panel, and we will invite you to ask the questions live to the panelists. I will get started with Akash.
Sure. So my question yet is to Doug. I'm already a big believer about Sharesight. Congratulations, you have a very good business out there.
Thanks.
But in terms of taking the whole picture, what all things would you recommend in terms of a broker, in terms of a research screener or something like that? And then, obviously you have your site for tracking, and just in general, which news site, which things to read, and basically for any beginner in Australia, and mostly focused towards international markets. Yeah, that's it.
Yeah. No, thank you for that. Thanks for the kind words as well. I appreciate it. Yeah. So in terms of like tools and platforms to think about, The one thing that was kind of beaten into my head at Morningstar was that kind of doing from a researchy background was that the only guaranteed outcome in investing are the fees you'll pay to do it. And if you look at how you invest over time, fees, especially in like mutual funds in the States where I was, managed funds here, they bleed you out over time. They really do. So with that being said, I would always go for a low cost broking option. I won't, recommend one or the other. We have various relationships with some of the major share brokers here. Look for one that you can get cash in and out of quite easily. That may be one that's linked to your bank. However, those tend to be on the more expensive side, sort of maybe $10, $20 a trade, which in global terms is actually really expensive. There are some free brokers out there. Just read the fine print with those because they tend to charge higher rates on cash accounts. They tend to charge very high rates on Forex transfers. A lot of them will, claim that they've got, free international investing. But of course, you have to if you're in Australia, you have to take your Aussie dollars, convert them into whatever market you're investing in. And that's where they tend to take their pound of flesh. Nothing wrong with that. Just be mindful of where they make their money. So that's kind of on the brokerage side. But brokers are really commoditized. I mean, it's, you can place a trade and get almost instant, fills and all that. So on the research and news side, I would always go for an independent provider. So, I mean, I spent 10, 12 years working at Morningstar, and I can tell you they're totally independent. They employ analysts who are independent. They analyze companies, and the analyst is free to say what he or she thinks about that company. So look there. They've got really good kind of fundamental plain language research as well. So take a look at them. That would be kind of my response to that.
Okay, I'll move on to the next question. The next question will be from John Oakley. I'm going to let you talk.
Hey, so I was wondering about ETFs, and they seem like a good option for people who have a relaxed, positive view of the market, like long term. And I was wondering if they get overpriced compared to the shares that they contain because of that, because everyone's freaking out and selling the individual shares, but people are buying the ETF who are more relaxed. So are ETFs overpriced at the moment?
Yeah, so an ETF's job is to track the portfolio of the underlying index that it's supposed to be tracking. So if you take, say, a Vanguard index fund, for example, it will buy and hold the top 300 companies in Australia. And so as the shares in that portfolio change, that'll be reflected in the price of the ETF's shares or the units as they're called. So they generally can't be priced more highly than the underlying basket of shares, even if ETFs are popular. If people are making the claim that, say, ETFs are overpriced, you would have to be therefore saying that the actual market is overpriced, because if we're talking about plain ETFs like an index fund, it's simply tracking the price that you're seeing is tracking that underlying basket of shares.
Yeah, I maybe just add a couple of comments. Dave's spot on, and I think in that case, stick to the big mainstream ETFs like the Vanguard Aussie Shares ones or iShares or things like that. There can be in some of these weird like synthetic ones. There are these weird things where like the assets they claim to track, they actually don't have enough inflows to buy all those, and there's some synthetic action happening. But don't worry about that stuff. Stick with the mainstream stuff. And Dave, you mentioned you use LICs before too. I think sometimes there can be more of a spread between the unit price for an LIC and the portfolio of assets that it tracks.
Yeah, definitely. So with LICs, the price can trade at because they're a company, not an ETF is a trust. LICs are a company structure. So their shares trade at any price that buyers and sellers are willing to buy and sell at. So they can trade at a 10% premium or a 10% discount to the underlying basket of shares that that LIC owns. And that can fluctuate over time depending on demand for the shares in each different LIC. So that's important to remember as well. They're much different to ETFs in that regard.
Right. All right. I'll move on to the next question by Dhruv. Dhruv, if you would like to ask your questions to the panelists.
Hi there, guys. So the main question I had was during the current pandemic, we've seen a lot of sort of alternative assets, commodities, cryptocurrencies, properties. Maybe like it's a little bit on the iffy side, but would a suitable strategy be to go and invest in the alternative assets during this time, or would it be to swing towards the equity side and basically like move your portfolio in a way that like sort of hedges against the current market movements?
Interesting question. So commodities, if I remember right, like gold and crypto, and that actually fell when the share market fell. I think crypto fell even harder than the share market did back in, I think it was between February, March, around that time. So they didn't provide any sort of a hedge when the market was falling. Property's a little different. Listed property or residential property. But in terms of what to buy, I mean, it depends on your overall strategy. If you wanted to buy something that, I guess it really depends on what you want to do. I mean, I personally don't like crypto and gold and stuff like that because they're not really a productive asset. They don't produce any income. They're not like there's no like underlying business model there. They'll go up and down based on popularity. But whereas with something like the share market, it's based on underlying drivers like company earnings and stuff like that. So there's some real tangible, I guess, cash producing assets that are underpinning the value of those shares. So that's my thoughts on that situation.
Mm-hmm. Yeah, I might just add there that it's all about your own kind of risk tolerance and your own experience levels with alternatives. I stay away from them. My alternative is cash. I go to cash if I don't know what to do because it's liquid and I can get back into the market if I want to. It's such a broad basket too. Commodities is what? Commodities is oil. Commodities is soybeans. Commodities is it's a huge range of things. And alternates or alternatives is like that's also a really wide category too. Like it's an alternative to what, So you just got to be. It sort of depends on what you're going to be looking for in there, but
depends what you want out of the investment, I suppose, doesn't it?
Yeah, exactly. Yeah, it's the alternative to a good idea, perhaps, is to to do that. But like I think it's especially something like crypto. I mean, we're sort of facing down what may be a global recession, and to put money in crypto, which has a lot sort of no track record compared to equities is wouldn't be for me. But so that's why I said before I kind of look at this as an opportunity to look for some quality companies at a slight discount, really.
Yep. Dan has a question on shares.
Okay, I just had one question. Using the ANZ platform for some share trading in the last few months, I often see the target price from the various analysts. Now they have Morningstar, which they give more like data on, but they also show in the news section the other like analysts' target price. So I was just wondering, with my Sharesight account, is there any way to try and see what the various valuations may be, whether it's a blend of the target prices or certain ones? Is there any way to do it apart from just doing something in Excel yourself for your portfolio? There was just one question that I had, because otherwise that's something I tried to do manually just to see what the range of values are.
Yeah, it's a good question, especially given the volatility we're seeing. And thanks for using the product, Dan. We appreciate it.
Sure.
I guess we do have a price alert feature in there that you can turn on, but that's at preset thresholds. So if you're looking for something that's a bit more finely tuned, that's probably not going to do it for you, to be honest. I would always, if I'm going to be as sort of attuned to the market to look at price alerts and things like that, I would stick with my share broker and see if ANZ offers like a price alert service or a real time pricing service, because the prices in Sharesight will always be 20 minutes delayed. So you may not be updated at a frequency that you like. But yeah, there's kind of no automatic way to tie in kind of a target price and set that as a setting, and then kind of be alerted to it. But it's a valuable idea though. That's yeah. I should also say too that we've been working on an integration with a research platform that'll be announced publicly soon, and that will give you more of an ability to kind of see your real holdings versus sort of target prices, and then you can in one place. So I guess stay tuned for that. I can't say too much more at this time, but it's a good idea.
Right. Grace has a good follow-up questions on that big picture, looking at big picture in terms of setting your investment strategy. Grace, if you want to ask your questions.
Hi, I'm Grace. I'm calling in from London. I just had two questions. So the first one is, do you guys have a set strategy or investment framework for identifying a good company or potential equity to invest in? So perhaps something like, after identifying a particular industry, if there's a 4 or 5 step framework that works consistently well for you, consistently in quotation marks. And the second question is, what sectors are you both currently optimistic about for the post-coronavirus recovery, or are you focused on long-term capital appreciation from solid large cap firms?
Maybe I'll go first. I don't, as I was saying in the earlier questions, I don't really get into individual stocks and individual sectors much anymore. So I don't have any solid views on what I think, say, will recover the fastest or do the best in the next kind of environment that we might move into. In taking a big picture view, what I do is I think about where I'm happy to have my money invested for the long term. And for my situation, that is to have a good portion of our savings in Australian shares, but also have some investments in international shares. And since I don't want to do the work of stock picking, that leads me down the path of low cost investing in the form of index funds and some other things. But yeah, that's my approach.
I guess mine it would be a bit different. I like to start with macro themes, so macroeconomic themes that interest me. Not saying that's the right way to do it, but they can hold my attention, which is important. So that goes along with kind of investing in what you like, right? So I guess 3 areas that interest me, and I'll just explain why right now. And again, this is not a recommendation. I don't have an AFSL. I just run a tech business, so this is my own personal viewpoint. So 3 things that are interesting me right now are healthcare, right, for very obvious reasons. Another area is technology, just broadly. Just given that we're using technology now more so than ever. Like we're using Zoom right now. They're a listed company. And another one is kind of digital transmission. So like things like 5G and things like that, which is kind of a tech kind of play as well. So those are all things that like I feel pretty well versed on. And it's like, all right, actually I'm not that well versed on healthcare, but my healthcare thing is, look, COVID-19, 1. Number 2, aging population around the world. People are living, for so much longer, and I've experienced that, with my family, for one. And it's like, okay, so if we're going to take those as kind of long-term plays, then we can kind of start looking for companies within those ideas or those sectors, and then from there, start doing your DD, right? Start reading those annual reports and kind of learning more about the companies and things like that. And then think about, Grace, I think you're in the UK, so presumably you've got access to the LSE, and which means you've got access to every share market in the world. So, and you're investing with GBP, so you're probably in pretty good shape in terms of an accessibility. Like, how do you actually put your money to work against that stuff? But that's kind of how I think about investing. And to kind of go a little bit further on the digital side, it's like 5G. Like how do I expose my portfolio to 5G? Like I'm sort of trying to work that out right now, for example.
Thank you very much.
Okay. I think we have the last questions. Adam Newman. It's a question for Dave if you want to ask questions.
Yeah, g'day. Thank you, Dave. It's Adam here. I've been reading your blog. Great work. You're inspirational with your communicating your message and your journey. I've had a fairly similar journey today in terms of primarily investing in investment properties, and I've got a reasonable chunk in an investment property that I've held for almost 20 years. My thinking has been I've got an equivalent home equity loan for that equivalent chunk of equity, and I've been toing and throwing as to whether I should jump in now, use the home equity loan to buy into primarily ETFs and perhaps some LICs whilst the market's down, and then when I look to sell the investment property probably early next year now, just replace that equity back onto my home equity loan. Any thoughts around that, or just simply spread it as the 12-month comes across, or wait until the 12 months has passed and the tenant moves out and then start next year? That feels too long to me. That feels like I would have missed the boat potentially.
Yeah, so first of all, thanks for the kind words and for reading the blog. So I guess a question like this is it's almost a question of what you think's going to happen next, and you kind of start playing this game of, should I get in now, and then what happens if the market goes up, and what happens if it goes down? And it's a tricky game to play because we really don't know what's going to happen next. So I guess it's partly about doing your best to avoid regret. So think about the decision or the outcome that you would regret the most, and whether that's investing a chunk now and having the market go down, maybe that would be your biggest regret, or whether it's waiting 12 months and seeing the market go up, maybe that would be a worse regret for you. So that's the way I'd kind of think about it in terms of what kind of outcome would you like to avoid the most in terms of making that decision, and that might help, because it's pretty tricky.
Yeah, sure. It's psychological consideration, isn't it, really?
Yeah, definitely.
Yeah, so more like risk analysis, I would say.
What was
Sorry,
that?
can you repeat that?
More like risk analysis, like analyzing what are the risks and what you're comfortable with.
Yeah, exactly, for your personal situation, and
Yeah. All right.
how you'd feel in either situation.
Yeah. Do you have anything else to add to that, Doug?
No, that's totally spot on. That's well said.
All right. We have reached the end of our session. Thanks so much, Doug and Dave, for joining us. I think a lot of people are saying that you're giving up, good advice touching for both beginners and intermediate investors. And thanks everyone for asking your questions. Thank you so much, Doug and Dave, and everyone. It was very, very good to see all of you. Bye.
Thank you so much. And
thanks,
I hope
everyone.
everyone's healthy and doing as best they can. Thank you.
Yeah, thanks. Bye.